This chapter will talk about accounting changes and error corrections. So there's different types of accounting changes that companies can make. So as we look through this table, we have a change in accounting principles. So basically from one generally accepted accounting principles to another. So maybe we go from FIFO to LIFO, or maybe our investments start to change and we go from the cost method to equity method, or the market value method to cost method. But again, all of those are generally accepted accounting principles, but it does change how we value things. A change in an estimate is like just saying, okay, wait, I think my estimated useful life for this piece of equipment is gonna go from 7 years to 10 years, or I'm gonna go from using units of production to straight line. Or I don't think my residual value is gonna be as high as it was. So those are all things that just kind of revise an estimate as the time goes on and we realize things are going to change. Then we could have a change in the reporting entity, which would have to result from us increasing our ownership. So maybe we had a investment that then now we've gotten over 50%, and now we're going to start to consolidate that company into our financial statements. We can also have errors, again, just mathematical mistakes, failure to record something, recording an asset as an expense. I mean, it could be due to fraud or negligence, but a lot of times it's just human error that happens. And then we catch it and then we have to correct it. So there's three different types of approaches. So our retrospective approach is that we go back to the financial statements in those prior years and we revise them. So say if we change our accounting method from FIFO to LIFO, we go back, whatever, if it's the 3 years that we're showing in our annual report, we revise all 3 of those years to say, this is what we're changing it to. This is what the numbers would have been, so that it's more consistent as you look at it. Or if it was an error, you go back and you correct that error as if it had never happened. The modified retrospective approach says that the new standard is applied only to the current period, and then we're just going to adjust our beginning of the year retained earnings balance. And then the prospective approach says that we're only going to adjust the current year and future years. So if we have a change in the accounting principle, so from one generally accepted accounting principle to another, so again, like it's saying here, many companies can change from FIFO to LIFO, and have done that. So again, those new circumstances may make that method more appropriate. Maybe it's going to be something that's mandated through a new accounting standard that FASB has created. But so now this is going to show if we have a change in the accounting principles, we are going to report those retrospectively, or most companies do report those retrospectively. So then we would go back to say, okay, if we're changing to FIFO, our cost of goods sold would be this, like these numbers here if we're using LIFO. Now we've changed to FIFO, and these are our new cost of goods sold numbers, which is and that's our differences. So then you can see that our operating expenses are going to be adjusted. Well, I guess our operating expenses don't impact our cost of goods sold, but our cost of goods sold would be, of course, adjusted, and that would impact our gross profit. So then they're going to put them all in there, again, with the updated cost of goods sold using the FIFO method, and then we'll calculate out our income and our taxes and then our net income. So we are retrospectively applying that accounting principle change. And then in the balance sheet, we are also going to note that our inventory is going to adjust based on using that other method. So our inventory is going to be higher, and then in those years, and we would report that as if it had happened. And then this is showing, okay, then what happens then in our retained earnings, because again, our net income is going to increase, and that will show our net income revised for each of those 3 years, again, less the dividends that were paid out. So then we have to book it, though, actually into our ledger. So then we're going to increase our inventory and then increase our retained earnings and then adjust our income tax payable. So then the difference, again, is going to be subject to our tax rate. So that is our entry to get our retained earnings balance to where it should be, and then our inventory balance to where it should be. And then in our financial statements, we have to have a note that explains why we made the change, and then point out that that comparative information has been revised so that all of our users understand it. The modified retrospective approach, we're just going to apply it to the current period only, and then adjust the balance of the retained earnings at the beginning of the period, without actually going in and adjusting all the numbers of the prior period. Now then here it says that sometimes a lack of information makes it hard to report that change retrospectively. So then we're just going to apply it prospectively in the future. Okay. And then when that new, if there's new GAAP that changes and we have to do that, then that's going to require us to do the prospective accounting. So if we change, like for example, from an equity method to another method to value our long-term investments, we're going to do that prospectively. Now, if we're changing depreciation or amortization methods, that is going to also be accounted for prospectively. Oh goodness, sorry about that. Because it's going to change our estimates in the future. And then a change in the estimate, again, is just prospectively. We would have a disclosure note that is going to explain how that impacted our net income, our income from operations, and our earnings per share. So then we'll go through some different examples of them. So here we have, they had estimated warranty expense of 2%, but then after review, they determined that really it's actually probably 3% of these warranties, that are actually getting turned in. So then we're going to adjust for that change. So the entry would be to take 3% of the $400 million in sales and then set that up as our liability. Now then it tells us, though, our prior periods are not revised, and then there's no cumulative effect on the estimate. So we're only going to do it in the current years and later years. So we're going to just bump those up to 3%. And then notice here then in the notes, we're going to say that they revised their percentage. It's a better indication of the cost experience. And then it decreased our income by $3 million. Now then they also have an after-tax effect of the change. So again, because that expenses will be deductible on our taxes, so then that's going to save us the taxes. So our net effect is going to be less the $1 million of our tax. So that's where that $3 million comes in. Now our change in depreciation method, so say we switched from the sum of the year digits, which nobody uses, to the straight line method. So we've got, again, what it was using our sum of the years digits for 2022 and 2023, and what's currently in our accumulated depreciation. And then when we switch it to straight line depreciation, again, it has a useful life of 5 years and a residual value of 3 million. So that would be the 60 million divided by the 5 years. So that gives us $12 million a year. If we are 3 years into it, then our accumulated depreciation should be 36 million. So that would leave a book value of 27 million. And then we are now going to depreciate that over the remaining 3 years at $8 million a year. So we've changed it, I guess, just at that point. So then here again, the $8 million difference that we saw, we're going to just debit the depreciation expense and credit accumulated depreciation, just like we would do any depreciation entry for the remaining 3 years of the asset. The change in the reporting entity, again, it would have to result in a change of us acquiring another company or acquiring enough of their stock to be able to consolidate them. And then we're going to prepare consolidated financial statements versus individual financial statements. So then we're going to recast all of those previous periods of financial statements as if the new reporting entity existed during those times, because it would make it very non-comparable to go from, hey, these were our individual statements to these are our combined statements. So we're going to combine them on that 3-year look back or whatever we have in the notes to the financial statements, so that people can really kind of understand the differences. Okay, so then here we have errors. So if we make a mistake that we incorrectly recorded it or we forgot to record it, then most changes and correction of our errors are going to go back retrospectively. So prospectively are just changes in our estimates that involve depreciation, changes in accounting principles when we really don't have the numbers to go back to make them retrospective, and then changes in the accounting principle when it's mandated that we do that. So notice though, the correction of the errors, we're going to go back retrospectively and restate those. So then this gives you a nice little table, which again, you may kind of come back to when you're doing your homework, because there will be maybe a couple questions, at least one for sure, that asks, do you do it retrospective, prospective, you know what I mean? And then you want to know. So if it's a change in our accounting principles, we're going to do that retrospectively. A change in our estimates, it's prospective only. A change in our reporting entity, we do that retrospective. And then any error corrections, we do that retrospective and go back and correct it. And then notice all of them have a disclosure that we need to disclose that. The prospective ones, we don't go back to any cumulative prior year adjustments. And then of course, yeah, so that I think that's pretty much what you do. The rest of them you do. So again, nice little summary there. So here we have some different types of errors that we're going to kind of walk through. So first and foremost, you got to do a journal entry to correct the error, to get the account balances back to where they should be. Then the second step is to look back at those previous year's financial statements and then retrospectively restate them, reflecting the correction. So put them together as they really should have been put together. And then if our retained earnings is incorrect, as a result of this error. We're going to have to record that prior period adjustment in the retained earnings so we can see how that balance has changed. And then we do a disclosure note in our financial statements to explain the error. So here we have our statement of retained earnings. So this is what you would normally expect it to be. We have a beginning balance, we add net income, subtract our dividends, and we have a balance at the end of the year. Now, when we have errors, we see that we'll have what is called a prior period adjustment that adjusts that beginning balance and then shows us the corrected balance. And then we add our net income and subtract our dividends. So again, we'll walk through a couple of the errors. So it is significantly more complicated if we realize that net income is from a prior period and if we don't discover it until a future period. So we've already closed the year and now it's February and we discover, oh shoot, there was a material error that we need to correct. If it's in the same reporting period, obviously it's easy. We just do a journal entry to correct it. So as long as we discover it in that same accounting year, there would be no issues at all. So again, we're going to reverse our incorrect error and then record it correctly. So in this case, we charged something to maintenance expense when it should have been to equipment. If it's something that impacts our prior year's net income, then we're going to have to retrospectively restate those financial statements. We're going to have to correct the incorrect account balances and then adjust our income taxes that are owed and possibly our cash flow statement. So here we have that we omitted a depreciation entry. So we omitted it in both 2000. Oh, I know. So if we start at the top, we should have capitalized this machine, this piece of equipment as a capital asset, which we would have depreciated. We instead charged it off to expense. So this is what we incorrectly did. So then we have to correct it by going back to 2022, setting it up as an asset, and then at the end of 2022 and 2023, recording depreciation expense. So then we're adjusting our expense on 2022 and our balance sheet on 2022. And then we're adjusting our expense in 2023 as well. So we've got 2 years that we need to adjust. So then we are correcting the accounts to bring them up to what the balance should be. And then notice then for what would have gone to our expenses, it's going to go into our retained earnings. And then we're going to restate those 2 financial statements to make those correct. And then in our retained earnings, again, we would have that prior period adjustment spelled out so everybody could see it. And then we would do a note to the financial statements. Okay, so then, so again, it says, if the error would not be discovered until later, where the asset's now going to be, I guess, fully depreciated and fully expensed, then there'd be no correcting entry needed. It's already washed out into the income statement. So then this is another one that I feel like you will have in your homework to just understand. Like if there is an error, it likes you to understand like, okay, so here we had an inventory count. So we had an inventory count that we inadvertently did not count $1 million of inventory. So our ending inventory is going to be understated, which makes our cost of goods sold overstated. So then our net income is going to be understated and our retained earnings are going to be understated. But when we carry that error through then into next year, then it kind of flip-flops, right? So our beginning inventory is understated. So then now our cost of goods sold is going to be understated. Because again, we started with less and that's what we're charging off to cost of goods sold. So if that is less, that would be less. Then if our cost of goods sold is understated, our income is overstated, and then our retained earnings would wash out. So any inventory adjustments over a 2-year period, they would correct themselves. But we still should do the journal entry to that prior period to bring our inventory up by that $1 million that didn't get counted and bring our retained earnings down. And then we would restate those financial statements to correct the cost of goods sold, the inventory, the retained earnings, and then we would show those as they correctly should be shown. And then our retained earnings is going to have that prior period adjustment, and then we're going to disclose it in the notes to our financial statements to explain why it happened. Then another type of an example, what if we failed to record sales revenue? So in 2024, we discovered that $3,000 of credit sales in the last week of the prior year were not recorded until this year. And they did not count it in the inventory, so they didn't count it, but then they didn't count it in sales. So it should have been recorded in accounts receivable and sales revenue. And then there was nothing done in 2023, but in 2024, it was recorded as accounts receivable and sales revenue. So then we're going to go back to 2023. So the 2023 statements were incorrect. So we are going to, I think this is actually taking it, so it's taking it out of the sales revenue for the 2024 and then putting it into the retained earnings, because that's where what should have been in, it should have come over from last year's sales. And then our beginning of the year's retained earnings would have been correct, but the prior period, no. So the retained earnings was incorrect, so our prior period adjustment would go to that beginning of the year retained earnings, because again, we didn't record the sale until 2024. And then we would have a note in our financial statements explaining how it happened. So you just want to kind of understand the different types of errors that could happen and then how they get corrected. But basically, you go through those same 4 steps and do it retrospectively.